Over the past few months, we've had finance giants like Jeremy Grantham, Charlie Munger, Michael Burry, and Ray Dalio sound the alarm for a mega crash in the US equity market. There's also been a lot of hue and cry about excessive valuations in the debt markets too, and as the days go by, the US economy seems to be losing its marbles, and it would not be smart to ignore what might be the deadliest ingredient of this Molotov cocktail: the real estate market. Now, all humans labor in the endeavor to upgrade their lifestyle, either for the commodities they consume, the nourishment they desire, or regarding the roof over their head. Single-family homes have been a vehicle of personal consumption as well as an investment opportunity for years amongst retail investors, but now there's a new bully on the block. Today, guess who's the biggest home buyer? An industry once dominated by boomers and was once assumed to be taken over by millennials and then Gen Zs is now being disrupted by giants on Wall Street. In the past 2 to 3 years, if you've been looking to buy a house and are wondering why the odds aren't in your favor, the answer is simple. You are a fish, but there are blue whales operating in that same water. Major banks and institutions from New York like BlackRock, Goldman Sachs, JP Morgan, and Carlyle are on a real estate shopping spree where they're out to acquire every family home they can get their hands on, unfazed by the prospect of paying obnoxious premiums for those homes. Now, I'm not making this up. Reports indicate that in the last quarter of 2021, 1 in every 5 homes in the US was sold to a financial institution. In some locations, that ratio is closer to 1 in 3 homes. Now, what I find fascinating is that Wall Street in the entirety of its history has never really bothered to validate the single home market. They've always focused on selling equity, debt, or various other financial commodities, but now suddenly there's a massive interest in this sphere, where billions of dollars are being pumped in at obnoxious velocities. This makes it look like bankers are artificially inflating prices, meaning the average American is struggling to compete in the same arena. Wall Street has a notorious reputation for being at the forefront of numerous scams and bubbles, so disregarding the concern of another housing bubble would probably not be wise. Occurrences in the financial and economic world affect us all, and so I'm going to attempt to break down how all of this started in the first place, what it means, and what we can expect. Now, before the pandemic wreaked havoc upon our lives, institutional investors comprised about 10 to 15% of all family homes in the economy. But after the pandemic, those numbers soared to about 25%. So here's our first big question. Why do the big boys on Wall Street have this sudden urge to become new landlords? I mean, traditionally, we know that they've always been the ones trading paper assets, selling us mortgages, or packaging them up into fraudulent investment vehicles destined to crash the economy.
When you have thousands of them all bundled together, suddenly the yield goes up, but the risk is still small because, well, they're mortgages. And who the hell doesn't pay their mortgage?
Exactly what the Michigan State Pension Fund has been looking for. I'll buy $20 million.
Oh, come on, live a little.
$25 million.
The money came raining down.
So why do they need to enter a market of tangible assets, a space which would just bloat their balance sheets? I believe this needs to be answered by zooming out and seeing the state of the overall economy first. The US is suffering from dizzying inflation figures. Rampant quantitative easing and near zero interest rates have blown up inflation to 8.5%. The dichotomy is that despite there being insane amounts of liquidity in the market at this point, people's wealth is actually being eroded away, all the while they think they're getting rich. The valuations in equity markets were through the roof, where PE ratios of 50 or 100 times weren't uncommon. Bond markets too have been overvalued, as the 30-year treasuries are at all-time lows. For an institution, at this point, there aren't a lot of viable options to make money in the paper assets market. Frankly, mid-level brokers and companies have always existed in the housing market, but in the past, it was almost ridiculous to imagine the giants of Wall Street setting up large sales, rent collection and maintenance terms for properties across different locations of the country. Too much effort for too little reward was the consensus, but we're talking about mega institutions here. These guys basically have unlimited money to hire the best minds for the problems they're trying to solve, and that's what they do. 2 years ago, when the banks decided to enter this market, they didn't wait for resale or disputed properties to start with. They literally went in and started buying up entire localities. They were willing to take a bet because they were aware that the only competition they had were the nuclear families of America. It's almost like a fist fight between Mike Tyson and a guy on a plane trying to annoy him. So when they realized that this is the only market with potential upside and low competition, they chose to seize that opportunity. So what does this mean for the affordability of homes in the US, and what can we expect in the future? Well, over the last year, we witnessed a surge in housing prices by about 20%, but the average wages of Americans only grew by 4%. So what does that mean? Well, this means that for the most common folk, it's already nearly impossible to afford a house. You can see that the average 30-year fixed-rate mortgage was at a low of about 2.7% in January of 2021, literally an all-time low. Underwriters at banks just couldn't pass on people wanting to buy a house as their income bracket simply did not qualify for the loan amount. The point I'm trying to make here is that the mortgage industry is freaking out. The cost of a mortgage to own a home is getting costlier by the day. In fact, the cost of home ownership, or the cost of a mortgage, has gone up by a whopping 9 times more than the average income. This is unprecedented and has never happened before. Historically though, whenever demand has reached a state of unsustainable frenzy, it always indicates a bubble. We've already established that the housing market prices are being rigged by the new corporate landlords who have unlimited money to pump, but at what point does this bubble burst? Well, most retail investors jumped onto the bandwagon of buying homes when mortgage rates were low, but there was another problem which was creeping up faster than they thought: inflation. The US government and the Fed need to fight tooth and nail to curb that 8.5% figure and neutralize the economy, and for that, they will need to increase interest rates. Now, obviously, as interest rates rise, so will mortgage rates, which will in turn make it more expensive to get a good deal on your mortgage, driving demand down. At present, US home prices are so outrageous that consumers who are considering buying a house may well regret it in the months to come. Of course, everyone has their own reason to buy a house. It could be a personal aspiration, or it could be an investment, but buying now means you will be shelling out an insane amount of money. The search for a home to purchase, though, is merely the beginning. Then there's the mortgage to pay. According to data from home listing site Zillow, a 30-year fixed-rate loan now costs $1,230 per month. This has increased by 36% from a year ago of $905, and that's up 6% from January alone. Now, in case you're someone wanting to buy a house, I'd like to refer you to the predicament post the 2008 housing market crisis. When Lehman Brothers crumbled and the overall sentiment was horrible around housing, institutions and banks were in a rush to get rid of the homes they invested in. The situation was so dramatic that some houses were listed at an 80 to 90% discount to their intrinsic value. Frankly, for someone wanting to buy a house then, this would be a sign from heaven. Coming back, there's also a narrative that analysts are crying wolf about the real estate bubble. So here's my take on that. The reason some people are saying this is because they feel that now that Wall Street has entered the game, most deals are happening in cash, and since Wall Street is a money machine, it's going to be a very hard bubble to pop. Now sure, Wall Street is paying cash upfront for most of these property sales, but they are still a minority of the total buyers, merely 25%. The remaining 3/4 of those buyers are the ones using mortgages to purchase homes, and this brings me to my next point. The real estate market is way more sensitive to mortgage rates than cash deals. When mortgage rates rise, house buyers leave the market because they literally can't afford to transact at prices that used to be possible for them. We see demand destruction as buyers just disappear, while more sellers enter the market at the same time, forcing prices downwards. Another major factor to consider here is that rental rates haven't actually caught pace with the overall price of the property. This is critical because as a retail investor in real estate, I expect to receive a monthly income in the form of rent and eventually hope to sell the property in the future for a decent sum of money. Over this period of time, since this is a personal property, I'd also make sure that the house remains in good condition to maintain its quality throughout the years. The problem is though, when we're talking about corporate landlords, they don't act the same. With the speed at which they are acquiring houses, it's nearly impossible to maintain quality checks. And at this point, they aren't just outbidding retail investors, but they're also letting out houses at significantly lower rents to customers. For a retail investor, the monthly rentals serve as a means of income through which he or she can pay the bills of the family, education, healthcare, but that's not the case with Wall Street. Institutions with large bellies can absorb losing out on monthly rentals to eventually keep the prices of homes high for them in the long run. What we may well be seeing here is that they want to increase the prices of the homes for long enough that consumers go from real estate buyers to real estate renters, at which point raising rents will be relatively easy. One of the lead analysts at The Fortune says, and I quote, "The housing market has gone into a savagely unhealthy stage. Everyone should embrace higher rates to cool off this madness and hope inventory rises. Let higher rates do their thing." This obviously cannot go on forever. Practically, there cannot exist a prolonged phase where the disparity between affordability and real prices keeps increasing. The market will have to have its due correction, and eventually, sellers will have to reduce prices drastically. It's easy to identify the heat of this market, but accurately gauging how dramatically this bubble will burst is a lot harder to guess. From the looks of it, it seems like the scare of an overvalued real estate market has plagued the entire North American continent though. In recent news, the government of Canada has banned the sale of homes to non-Canadians for a period of 2 years to try and cool the country's housing market. Additionally, the government also stated that there will be higher taxes for people who sell their houses within a year, though both measures include multiple exceptions, including some for permanent residents and foreign students. This decision by the Canadian government comes after seeing a massive 20% plus surge in housing prices across the country in a single year, coupled with increasing rental prices. We are living in extremely volatile times, to say the least. Political instability coupled with poor economic fundamentals has clouded the judgment of everyone since the pandemic really kicked off. We're living in times of cross-border turbulence, deadly inflation, and outrageous valuations. The United States is pushed up against a wall at this point, and my fear is that when it swings its arms in retaliation, laymen will bear the brunt of it. I am sadly of the opinion that all bubbles stem from poor governance and weak regulation, but I'm also of the opinion that herd mentality in the market is the most dangerous predator of individual wealth, and the only cure to that is awareness. As retail investors, it is our responsibility towards ourselves and our near and dear ones to protect and grow our hard-earned money. With this being the state of the housing market, many people who have been dreaming about buying a home will be wondering if now really is the right time, and when it comes to that question, I'm afraid I can't make that decision for you. But I do implore you to just be cautious, be frugal, and ensure that no matter what comes, you haven't overstretched yourself. During recessions, car prices fall, and people who financed expensive cars that they couldn't really afford find themselves underwater with debt. The same thing happens when house prices fall, but those who are smart and buy a home with the intention to live and be happy within it will find themselves able to weather the storm. Make sure that you have contingency plans. Make sure that if mortgage rates do rise a few more percent, you can still make your payments, and make sure that you're not going to be forced to sell while the market bottoms. We constantly hear advice that for long-term investors, just holding your positions while the market tanks is the best idea. And while this is usually true, sometimes people sell because they don't have a choice. They have too much debt and not enough cash to service that debt. Just make sure that doesn't happen to you. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. They can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, a site that allows you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you think that crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.